Welcome to the Real Vision Daily Briefing. With me to break down the latest in the banking crisis that's unfolding, Karsen, founder of Volatility, and Julian Brigden, co-founder of MI2 Advisors. Hi to both of you. So grateful to have you both here with us.
Thank you for having us on the show, Maggie.
Hey, Maggie. Good to be here.
Hi. Jem, did I say your last name right?
You did, but the name of the firm is Volatility.
I knew it. I went back and forth. I'm car shopping, as everyone knows who's been bearing with my trials and tribulations. So I'm going to blame it on that. So
funny.
I got 50-50 there. But seriously, I'm so happy to have both of you here today because I think a lot of folks listening out there are nervous. They have a lot of questions. So do all of us, I think. So do we. And this is exactly why Real Vision was launched in the first place, exactly to try to help people through sort of stressful times like this. So we're going to do our best for everyone listening to get you as much information as possible and help guide you through it. If you haven't already, hit the QR code for a free trial and access to all of our coverage. And go ahead and drop your questions in the chat as usual. And we're going to get to as many as we can. Okay, let's jump in. So I really want both of you to just give me your reaction to what unfolded today. Julian, let's start with you. We did have the Credit Suisse obviously under extreme pressure today. We did have the Swiss come out and say that they will provide liquidity, kind of a very general statement right here at the end of the day. What do you make of this?
I mean, to be brutally honest, Maggie, if I want to be the cynic, we've known that CS was on life support system for a long time, right? This has been a bank that has been dying. It's like that movie scene, I can't remember, you just die already, right? Just do it, get it over with. Now, if you're a cynic, you say, why did the Saudis say no publicly, all of a sudden we're not just going to put any more money in it, right? Well, there's rumors that they want to buy the asset management arm, right? And the wealth management business, right? Okay, so maybe that. I mean, you could say the same about Goldman. Why would Goldman advise Silicon Valley Bank to come out and recognize a massive loss on their security book, which would make them insolvent, if they hadn't already had the funding lined up? Well, the rumor is Goldman wanted to buy, SVB. Now, don't get me wrong. This has hit a market which is extraordinarily frothy, right? And everyone is going, most of the young kids in the market going, oh my God, this is '08 again. I don't think so, right? Don't get me wrong, I think we're going to have a recession. We were always going to have a recession. This probably just makes it a bit worse, but is this the end of the world? I don't think so.
I think I feel better. I'm not sure, but I think I feel better after hearing that. Jem, what are your thoughts?
So we were pretty public about talking about near the highs there and recent highs in February that the Fed had one goal, and that was to take some of the froth out of this market. They wanted, they're selling calls, I said, to the market, not literally, but they're literally trying to dampen the upside and get the speculation out of the market. It doesn't mean they want a liquidation. The Fed never wants liquidation. They want to dampen volatility, right? So they've been sitting here trying to get this market down. This is not a cynical conspiracy thing. The reality is this is to some extent what the Fed wants, right? The Fed wants, again, particularly crypto froth, tech froth, speculative froth out of the market. Not a surprise that we see Silicon Valley Bank kind of get taken out of the market, that we see Signature Bank, right? Both players in that space kind of taken out. Board member of Silicon Valley Bank is on the San Francisco Fed, right? Like this is not an unknown thing. The Fed has, I agree, been with Julian, been kind of working behind the scenes, aware that this is something that would happen. Now, whether there'll be contagion, whether they'll be able to control it, is always a question. The Fed thinks they know what they're doing all the time, and things fall apart, right? We've seen that plenty of times. So I don't think you can rule out anything worse happening structurally. This is the last thing I'll say right now is structurally banks are, the way, by definition, a bank is a levered entity, and they generally have a short put in the portfolio, in the sense that they are levered with a breaking point on mark to hold to market securities versus marking them to market. And the second they have bank runs or money come off the table from their assets, if their assets are mismatched from their liabilities, they're going to have problems. And so liquidity, you can get a liquidity event where these things get out of hand, and the bigger player has to come in and support them, whether that's the Swiss National Bank or the Federal Reserve. That is always a risk in markets such as this. So it can get out of hand, but I think it was relatively telegraphed.
Yeah.
I will say, Maggie, just on that
Julian,
point, if I can jump in a
go
second,
ahead, please.
the big difference that you've got to bear in mind is that the European banks, and this is because they don't really have a lender of the last resort, because then you don't have that kind of, you've got the Bank of Italy and the Deutsche, Bundesbank and so on have to all lend to their own banks, right? The ECB can put money into the big facilities, but backstopping them, they're national, okay? They've already, even on their hold to maturity books, which of course was the big issue with SVB, even on their hold to maturity books, they are marked to market. Unlike the US banks, and their security holdings are much, much lower. And their mark to market books in Europe are less than 50% of any of the banks. And even the big boys in the US are 65%, and something like First Republic was almost 90, right? Or is almost 90. So there is a big, I just think the timing of this CS thing, whether you want to call it cynically, someone nudged it that way, right, or not, I think it's just hitting all at the same time. I do not believe that this is indicative of a global bank run. And if you look at, say, the CDS, so the credit default swaps, and I've got the screen sitting here, I mean, and I'll share it with everyone, right? If you look up, I think you can hopefully see it. So if you look at this, right? Oh, well, this is all the change here intraday in all the spreads, right? So here you've got Credit Suisse, obviously at the top. And then there's a big drop between 375 and kind of the next decent, well, Deutsche Bank's a bit of a basket case. Take the Swiss out. And then you're down to like, okay, ING, that's a big bank. It was up 15. Right? It's because it's part of the bloody indexes, right? I mean, don't get me wrong, were these markets overvalued? Have we run up a long way? Was an enormous amount of money in these European markets? Yeah, I mean, European banks are up 60% since October, right?
Yeah, I agree, Julian, but I just want to say one thing. Yeah, this wasn't a Credit Suisse specific point. It's just about the structure of the banking system writ large.
Totally
and at some point it becomes a self-fulfilling prophecy. I think we can agree on that. At some point it doesn't matter what is what you think, or if the assets come out, there are too many liabilities relative to assets because there's leverage.
Sure.
And at some
it's
point,
a confidence
every bank on this planet,
right?
other than one,
lend long, right?
It's part of the business. That's my point. Yes.
Yeah.
And so at core, like, there's always a tail, and if it gets bad enough, we will have a banking crisis, right? So it's a question of, liquidity at the end of the day, and who's willing to backstop it to stop, and the only entities that can are the biggest entities in the world,
correct? The
Federal Reserve, et cetera. So yes, I agree with your point. And again, as I said, this is relatively telegraphed. I don't think this is 08. I would agree with you, but that's not to say it can't be. And I think that's important.
And I think that's the worry, isn't it? And so, and you both touched on this. When it goes out of the realm of, like, once the ball's set in motion, so much of this becomes confidence and psychology. And that's it. So in terms of banking, Mike Green and I did an AMA the other day, and he made the point that with this episode, you have telegraphed to every depositor out there, well, you could put your money in a money market and get way more than you had it sitting in the bank. Now, that may not have been the intention, but through this discussion, that is one of the things that has happened. What is to stop everyone from moving from a bank deposit to a money market, and what does that do?
Nothing, Maggie. It's very easy. Look, I think it's very easy to do it these days. Click an app, right?
Right.
You can go into your BofA thing and go and buy treasuries, right? Go and buy an ETF, right? You take it out of your deposit account, it goes straight into treasury ETF. So that's very easy. But to some extent, we have to understand this is how monetary policy works, right? You drain liquidity out of the banking system so that you tighten bank lending and you screw the economy. That's how it works, right? The question is in the process, does it get a little overdone and we get these sorts of things for some of these banks that were, Credit Suisse, who was living on life support system, and sovereign bank that was going to go down anyway because they were up to nefarious money laundering stuff, or SVB because they clearly can't manage their arse from their bloody elbow when it comes to the balance sheet, right?
Yeah, I don't think
down? JP Morgan? I don't think so.
Yeah, no, I tend to agree, and I think there's other things at play here that matter in the short term. Ultimately, a liquidity run is a function of liquidity, and there's other dynamics at work in markets that will probably determine whether or not this finds a tail or not. Market dynamics broadly, positioning, very important. I don't think positioning is over-levered, and I think that in particular will play a significant role in making sure that the tail doesn't realize to the extent that people are afraid that it will. Obviously, the Fed, like I said, is also already out in front of this. There's also been regulation that's been in place for some time now that will make this less vulnerable, the market, the economy, the banks less vulnerable ultimately, given capital ratios relative to where we were in a way.
Feds, don't forget, Maggie, the Fed's already pumping liquidity back into the system. Well, that's why the bloody Nasdaq is up today, right? The Nasdaq's up again today. I looked at it this morning and I was like, I bet you they bloody close it in the green, right? And they closed it in the green. Why? Because the Fed's pumping in more liquidity.
So what does that do to the, what do you think that does to the, their moves when they meet? Because they're right now, people are still asking, are they going to raise rates? And technically they're still doing QT, although that now they're also doing apparently QT and QE at the same time.
Right. Give it with one hand, take it with the other.
Yeah.
What do I think? So look, in my former life, I used to be in a policy consultancy group that was all it did was talk to central bankers. And I've got a bunch of mates who do that still, and I talk to them. And I'm still hearing 25 from the Fed and 50 from the ECB. Now, there'll be dovish 25s and 50s, but that's still what I'm hearing.
Yeah, I think my personal opinion is the Fed has been looking for an excuse to pause for some time. Why? Because there are two contending sides of the Federal Reserve some that believe that this is Spanish flu and that all these effects might be short term, and that at the very least, having moved 5%, that we need to, or 4.75 or whatever, that we need to stop and take a look at 5%. And they publicly came out and said that holistically, that it's time to pause. The problem is that spurred a front run and then eventual 20% rally off the bottom. That's what these things do. And what the Fed doesn't want, which is helping create the wealth effect is helping create a hotter economy. And they don't want that wealth effect. They don't want the speculative action in the market. So what do? Well, they've been forced by the CPI and the hot employment numbers to come back in and kind of talk out of two sides of their mouth. But at the end of the day, the whole goal was to get the froth out of the market, not to not pause. So I really think this is what they've been looking for, except they need to make sure that the tail is covered. And I believe they do. I think this has been kind of part of the again, not fully telegraphed, because I can't tell you the number of times the Fed thinks they know what they're doing, and they kind of end up in a place that they'd rather not be. But I think this is what they intended to the great extent. And it's been very controlled, mind you. This is not like people are, crying right now, like acting like this is some massive catastrophe. This has been a very controlled, orderly sell-off in every way.
Yeah, absolutely. Which in and of itself, it makes it nothing like 2008. But there are other people that sort of worry because in the beginning it never feels like that until something happens or you get another event piled on top of it, which would explain, I think, why people are a little nervous. Julian, what do you make of the move we saw in bond yields We saw the 2-year German yield. I mean, we've seen moves that we haven't seen ever since they started.
Well, I mean, bigger
keeping
moves than the '87 crash, without a crash. I think you put it down to positioning, and I mean the CTAs. I was looking the CTAs who look as though they were massively short this stuff because it was still all trending higher yields. Apparently just had their worst couple of weeks in a decade, right? Because they got just blown away on this stuff, right? And so I think there's an awful lot of positioning adjustment going on, Maggie. If the Fed, look, I've been on the record, I've talked on, Macro Insiders a lot about this, started in, last year, that the market still doesn't understand the policy framework that the Fed is trying to pursue. They think this is, they're going to march rates up and they're going to march rates straight down again. And the only way that you do that is if you have truly destroyed the economy. Now, that's what Volcker did, right? It's referred to as deliberate disinflation in policy environments. So in other words, you take rates up to the point that you literally drown the economy. It's dead, done, right? No inflation anymore because I killed you all, okay? That was never the plan. The plan is what they refer to as opportunistic disinflation. So you ride rates up to a level which is restrictive, okay? And at that point, you leave them on hold for a long, long time. It doesn't preclude the possibility of a recession. You hope that something comes along that doesn't necessitate the recession. Maybe we get lucky, we have a huge burst in productivity and trend growth is higher, and so we can stomach those, and more of the growth goes to real growth as opposed to inflation, right? You hope all of those things happen, but it doesn't preclude it. But what it does is it takes a long, 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 long time. So this idea that we were going to march rates up and then just start cutting them again was never the plan of the Fed. Now, maybe to Kevin's point, maybe it was never going to work like that, and I'm pretty cynical myself. I don't believe the Fed ever gets it right, but that at least was the plan. So they must be looking at this in an environment where they've been trying to get the dot plots up and say higher for longer and go, well, we're not seeing the implosion you guys are seeing. So they need to talk that back end to push those yields back up bloody fast.
Yeah, because aren't they now pricing in, Jem, rate cuts?
Hundreds.
Aggressive.
No, not just hundreds of basis points of rate cuts.
Yeah, and I would expect that. I would expect people to come back out and trot out members of the Fed and start trying to talk it back up. I agree. I think that their goal was to get markets down, but I agree the pricing in of a reversal is, again, not what they want. If anything, I think the risk is back into the curve higher for longer, given that a liquidation is likely to bring more fiscal stimulus onto the market, is likely to push more long-term inflationary, structurally inflationary issues to the market. This is a cyclical pullback, which is good in terms of what they wanted. What they don't want is, more stimulus to the market on the back end. So I agree 100%. And again, if anything, I would be really concerned. I think the reason this market might have risk down is not because of a liquidation or a banking crisis. I think it's because of the bigger structural issues, which we've talked about, which is really the continued secular inflationary pressures that are likely to remove long-term liquidity from the market. So I agree the bond market is getting this wrong. There are structural elements that cause this liquidation to happen. It's a really function of money flows, but this is not what the Fed wants, and they will push back against it.
Yeah, Jay and TrillionX, that answers your question both about the Fed and the ECB, I think. Julian, I think it sounds like you and Jem agree on inflation. You're also in the camp that inflation, are you still of that view that inflation, we are in a sort of structurally higher inflation environment? Because I know you and Rao tango on this.
We do tango on it, Maggie. Look, I think it all comes down to timing. Short term, we are going to see inflation fall now, or in the medium term, let's say till the middle of next year. But to Kevin's point, the question is if we go into, which is my base case, 2024, which is an election year, with a frigging great big recession in the US, which we're going to get, does Congress spend more money? And my belief, talking to my policy friends in DC who talk to policymakers, is the answer is yes, they probably will. Now, the Republicans will want to spend it on different things than what they would say the woke Biden administration will want to spend it on, but they both want to get elected, Maggie, so they both want to be seen to be doing something. And I think ultimately that creates the same sort of broad fiscal stimulus that we got in the 60s into the 70s, which led us into a complete shit show, excuse my French. And I ultimately think that's where we're going. And at that point, then the Fed is going to have to make a choice, which no monetary policy authority wants to make, to cross a monetary Rubicon, which will send us to a world of bloody pain, because I do not believe they have a Volcker bone in their body, okay? And I think things in that sense get a hell of a lot worse over the next 5 years to 10 years in the US, not better.
Yeah,
that's
you see how Julian tried to make us feel better that it wasn't 08 at the beginning, and now we're just. Well,
it's a question of distribution, right? It's not a question of up down. And everybody's like, are we going up or are we going down? The question is, like, in the short term, are we in a banking crisis with a liquidity tail in the short term? Or are we in a structural secular decline? And those are very different market things. And you want to trade very different, things in your portfolio as a function of which one is more likely. What we are in is, I agree with Julian. I wish we didn't agree so much here, 68 to 82. And again, for the reasons he asked, I don't have to talk to policymakers to know that the average voter, which is a millennial every year, increasingly a millennial, does not believe the system is fair and believes that there needs to be a redistribution of wealth. And in particular, they're not completely wrong. Well, no matter how you feel about populism, is they're at 40% of the wealth creation and household formation that baby boomers were at this point in their generation. So guess what? And they can't afford houses, and they're trying to create families and buy homes. They're living at home. So you are going to get continued political support for those that want to, that are going to vote. And Donald Trump or Bernie Sanders or whoever you are, they're both populist.
Correct.
So it's just they're using different social policy cues to appeal to their base. But the reality is the rusted out cities in middle America are the same thing as the populism that's on the left. And that reality, I agree with Julian, is what will ultimately drive more and more fiscal stimulus. In the 1960s and 70s, LBJ created, the Great Society program. You would have thought that a laissez-faire Republican, Nixon, would come in and change that policy. Guess what? He not only continued it, he accelerated the Social Security. He did price controls. These are very populist ideals because he had to. Right. And the reality is every administration going forward here for the next 4, 8, 12 years is going to have to follow that path because this is a cyclical problem in the market.
Also, let's not forget, Maggie, just like the late 60s, in fact, worse, we're fighting a war. Then it was Vietnam. Now it's a kinetic war with Russia, an accelerative Cold War with China, and a climate change war. All of those demand vast quantities of money to be spent.
And that's not a coincidence. People think of the 60s and 70s, they attribute the inflation to three things. They say, okay, Great Society, fiscal spending, Vietnam War, and OPEC crisis, commodity problems. Weird, we're having similar things again, all kind of lining up. Is that a coincidence? No. Times of inflation, times of populism are times of protectionism. Populism by definition is people. People belong to countries and care about themselves and their country. Corporations are international. You get times of globalization during these other periods. During times of populism, you get retraction, you get more resource scarcity. People use the power that they have to provide to their people, whether that's commodities, right? Or whether that's defense, or economy or monetary policy. So these things, we are in a time of resource scarcity. It's a time of conflict. It's not a time of cooperation. And these ultimately continue to be more inflationary along the way. So all these things are connected. Vietnam War, Cold War, 60s and 70s, not a surprise we're having another kinetic war. Not a surprise we're having conflict with China. I would expect to have more and more problems with OPEC and other resource providers as well. And I expect us to now use that as a bludgeon as well. That is part of competition. And I would expect to have that type of action here in this generation as well.
So we have a question from Manuel. John, why do you think tech is so resilient?
My view is actually, to be clear, if we talked 2 months ago, you wouldn't be saying it's very resilient, right? People are very, we got a massive liquidation that started early on in the cycle that really front ran the liquidation in markets, started in February of last year, well before the market topped. Why? Well, a couple of reasons. One, positioning. Nobody was positioned for that going into the original decline. Guess what? Put positioning versus put call ratios in that space. Yeah, well, not the broad public. Likewise, I was as well. I was talking about it very vocally at that time. But but the important point here is the public was over levered to tech. After the liquidation, what does everybody do? Start speculating on a trend. The trend was down, and everybody started buying puts and retail and whatnot, and selling calls. And now, and was over positioned into commodity sector, other banking value per se. And guess what? Positioning gets too heavy one way, and then you get a broader liquidation, vol becomes unpinned, and you get a rebalancing. So a lot of the put decay off of all this, dealer positioning in the NASDAQ has been supportive going into March OPEX here. We've seen this particularly for the last week and a half. That's not a coincidence. It's because we're in a big quarterly OPEX with lots of put positioning in the NASDAQ. And where have you seen the greatest liquidation? The stuff the junk that went too high, which was ultimately the one that has the most risk, which is the Russell small cap value. There's a lot of junk in there that just went up with everything else. And that stuff now is the stuff at risk. Again, a lot of it's positioning. That doesn't mean the long-term trends, right, that we're looking at ultimately of money coming out of duration with higher and higher inflation aren't going to be these secular trends. What it means is that we're getting a rebalancing and we're shaking the weak hands, and it makes sense in this cycle and given where we are.
So we're getting questions, and I want to ask you both about commodities, because if you believe that we're in this, in this structurally higher inflation environment, then I'm presuming that you're both bullish on commodities, but I'm not going to. I want you to talk us through it. And let me bring some questions in here. Barris is asking, Jim, are you still on the same stance on the oil put? First of all, Julian, let's start with you. What do you make of? We saw oil down sharply. How are you feeling generally about commodities?
I think commodities obviously a pretty broad basket, but I would say you have to split it into two. There's precious metals, which a lot of people refer to when they talk about commodities, and then there's the rest, which is pretty industrial. I think the oil looks like crap. It looks like to me like we're continuing to follow the sort of 2000 chart pattern, in which case, sort of post as we enter a recession, essentially, Maggie. So I think oil probably goes down into, maybe we can get it into the low 60s, maybe upper 50s. I hope at that point that the Biden administration decides to refill the tanks, but I doubt it. Okay. The copper looks like crap. All the industrial steel usage looks awful. All of this stuff is coming down.
Is that because everyone's focused on the demand side?
Yeah, I think so, and rightly, right? I think everyone is forgetting that China, and look, I'm an old man now, and I'm allowed to scream at the TV. And whenever I hear people on, the talking heads on the TV talk about, well, China's going to open up, it's going to be disinflation because all this industry is going to burst through and whatever. And I'm like, you didn't think they were sending us stuff the whole last 2 years? They were sending us industrial products, right? They were sending us finished product. They were just locking the workers in the factory to do it, right? What they weren't doing is those workers weren't consuming. So the only commodity really that those people are going to consume is energy. Right, so energy probably is the better of the performer on a relative basis, but we're going into recession everywhere else. Precious metals.
Wait, but I just want to pause you one second there, Julian, and then we'll pick up on precious metals. We're at the bottom of the hour, which means that we're going to flip over to the platform. So for those of you who are members of the community, you'll see nothing will change. For those who are on YouTube, hit the QR code, come join us. There's a trial, and we want to get your questions in. So meet us on that side. Otherwise, we'll see you all tomorrow. Okay.